And I'm also going to record for that type of feedback. I just as a heads up, I don't send out this recording just because if you try, we do so many of these classes, these recordings are long. If you try and go back to it, I may have already deleted it, and I don't want all the emails about recording went away. So when I do the recording, I really do the recording for my own I guess tweaking purposes, specifically for what Joseph just said. Joseph said, it says I got your message, but so that'll remind me to go back and tell the team that it needs to include that instruction. So definitely drop all your questions and comments in the chat, and that'll help us have a different presentation next time. So with that being said, getting into our topic again for today, clear to close mortgages and the underwriting process for realtors. For those that are continuing to come in, there is the link to the handout. Once you put in your information, go check your email. Today's discussion, today's training, dialogue, primer is powered by Experts University and your Realtor Association of Palm Beaches. The Experts University is powered by Modern Mortgage Experts and Title Experts. For those who I have not had an opportunity to meet before, if this is my first time meeting you, hello, my name is Ray Cole Jackson. I'm a South Florida real estate attorney. I specifically focus in real estate investment and finance. A little bit about my background. I attended the University of Florida. So I always say go Gators, just to agitate any Seminoles that might be in the room. I attended Santa Clara University School of Law in California for law school, where I was the founder of the Real Estate Law Society. Came back home to Miami. I am originally from Miami, Florida, and got my LLM in real property development from the University of Miami School of Law. And I am a proud, see, Karen, there's always one. I'm a proud licensed Florida real estate sales professional. Got my first license in California while I was in law school. With that being said, as I probably previously mentioned, by virtue of all this schooling, I do love real estate. And I've had the opportunity to found a couple companies, Modern Mortgage Experts, which is our mortgage brokerage. And many of you probably originally know me from Title Experts, which is our title insurance and settlement services firm. And then, of course, we also have Experts University, which is our coaching umbrella. For those of you who have not, who are not a member of the Experts University community, feel free to join us. We do host currently, we're actually in the process of transitioning over into our own little community. Right now we're on Facebook, but we're transitioning to our own little platform community. But if you join, you'll have the opportunity to be kept abreast of all of our training programs, coaching programs, special events, all for the purposes of coaching and training realtors to grow their business. Mondays, we have now our weekly sales huddle. It is our mindset, new money, and market updates coaching call. We get in every Monday morning at 10 a.m. We've been doing it for the past few weeks now, and if I must say so myself, it has been very effective. The purpose of that call is to get you guys as professionals, really just get you set up for a successful Monday. I realize sometimes Monday can have a couple cobwebs on it, and the weekend might have been a little bit long. But Monday's a new week, and one thing I always tell the community, if you had an open house and you went under contract, or you had a closing, or whatever might have happened before Monday, with regards to your deals, it's time to go after new money, right? That is one of the things that, does it take a while to come to your email? Not so much. It came right to my email earlier. So I'm not sure. If you guys put in for the handout and you don't get it, we'll make sure that we send it out after, but I definitely got it. Maybe check your spam. Actually, Joseph, check your spam. But I definitely got it right away because I tested it. Thanks for letting me know. Our other trainings on Thursdays is the clear to close. That's today, as well as, give me 1 second. Let me test the email. I'm just messaging the team about your handout. Stacy, did you check your spam? Not receiving it. Oh, she got it. Never mind. All right, let me call the dogs off. I was messaging the team to check it. Thanks so much for that. Who do I need to mute? All right, a couple people I needed to mute. There we go. There we go. All right, perfect. So there's the handout again. All right, that was a little intermission to make sure that you guys are receiving the handout. Not next Thursday, the following Thursday, we'll be discussing closed and funded title insurance and the closing process for realtors. The following Thursday, we'll be back here discussing Realtor Beware, as is contract hotspots that every realtor should know. That's when we're going to go through that contract and really just hit the hotspots. You schedule for the Monday call on the same website, expertsuniversity.com. All right. I want to highlight that Thursday call on the 24th. We're going to go through the hotspots. So you guys know that we have the classes where we go through the contract, every section line by line, not line by line, but section by section. I had told the board not to say line by line because that would be a multi-day class. But we go through it section by section. But this call on the 24th is specifically targeted at where there are common mistakes and misunderstandings about how to execute that particular contract term. So that's the 24th. And then on Thursday, the 31st, if you enjoyed this class so much, we'll be back here again with Clear to Close, purchase mortgages and the lending process for realtors. All right. Today's discussion is powered by Model Mortgage Experts, right? Who else would talk about the mortgage call today but our mortgage team? So let's get into it. For those that are just coming in, I am continuously dropping in the chat the link to the handout for the day. Go ahead and put in your contact information and it will email the handout directly to you. All right. So let's get into our discussion. Clear to Close, mortgages and the underwriting process for realtors. This is a very timely topic. Hey, Jessica, this is a very timely topic at all times. It's a timely topic at all times, specifically because we know that a home is usually the single largest investment that someone is going to make. And most buyers are going to finance their purchase with a mortgage. Most are going to finance their purchase with a mortgage. And so that number is about 87%. That number is about 87% of buyers are going to finance their purchase, the purchase of their home. And I know, there's a lot of cash flooding, specifically South Florida, but there's still the lion's share of our buyers are financing their purchases. And so with that being said, it behooves the real estate professionals to absolutely understand, have a framework for understanding the mortgage process, right? So that you can advise your clients, as well as so you can have a level of confidence as you work through your transactions from contract to closing, right? So the objectives of our time together today is to go over purchase loan basics, the loan application and underwriting process. We're going to discuss your relationship with the loan officer or lender. We're going to discuss staying current with mortgage market, with the mortgage market and trends. And then finally, a bonus topic: how do you use your mortgage knowledge to grow your business? How do you use your mortgage knowledge to grow your business? Now, I would tell you, and unashamedly, guys, I'm not sure why we're dropping emails in the chat. I'm not sending anything out. If you go to the link, you can put your email address in at that site to get the handout for today. Okay. I want to go back to this point really quick. Whenever we come together, no problem. Whenever we come together, I want you guys to understand that it is 100% for the purpose of you growing your business. Even if it's a contract class, I want you to take that contract class, and that contract class, I would think, is going to build your competence in the area of contract drafting, contract negotiation. And as you build your competence, you're going to build your confidence, right? And as your confidence grows, it should grow your compensation. I unashamedly tell you that. Anytime you guys sit in a class, my thought process is, okay, now how do I go and convert this into growing my business, revenue, something, right? So any class, you should leave with more competence, which grows your confidence, which obviously should grow your compensation, because at the end of the day, that's what we're here for, right? All right, so let's get into it. Purchase loan basics. Purchase loan basics. I want to start here, just because it's important to know. It's a small difference. It's a small. It is a big difference. It's a small terminology variation, but it makes a big difference. So the loan professionals. I'm going to assume that everybody is, kind of square one. If you already know this, congratulations. Some may not know. So who are the professionals? I want to make sure that you guys understand the difference between the loan officer. A loan officer works for a bank, a credit union, or a mortgage lender, and they only offer the programs and mortgage rates that are available from the institution that employs them. Okay, so a loan officer, they are employed by a lender. And so they're only able to offer to buyers the loan products that are offered by that lender. That's important, because if you run into a situation where, for example, maybe the property doesn't qualify for, let's say, FHA or a conventional, or conventional is umbrella so big, but for some reason, and then even the buyer doesn't qualify, you would want that buyer to be able to pivot into another loan program, right? So it's important that you understand whether you have a relationship with a mortgage representative. I'm going to call them a representative, because by the time we end this conversation today, you guys will know whether or not you're working with a loan officer who's under a direct lender, or you have a relationship with a mortgage broker. We're going to talk about a mortgage broker just shortly. Again, the difference is your access to loan products, really at the beginning, in the middle, and as you get towards the end of your transaction, right? So a loan officer works directly for a lender, a direct lender. A direct lender is a financial institution or private entity that actually provides the funds for the mortgage loan, right? So some of your big examples of your direct lenders are Bank of America, Chase, Wells Fargo. Yes, there are buyers that still work directly with some of your big box lenders, right? TD Bank, yeah, they do. So these are your direct lenders. Compare that to a mortgage broker. A mortgage broker is an intermediary who brings the mortgage borrowers and the mortgage lenders together, right? The mortgage broker helps connect your buyer with many lenders, and they seek out the best fit in terms of the borrower's financial situation, interest rates, needs, so on and so forth. I want you guys to know that, because I always use the example, working with a mortgage broker or working with a loan officer who's employed by a lender is like ordering from just that lender's menu, versus working with a mortgage broker is like ordering from DoorDash. DoorDash, you get everyone's menu, right? And so that opens up a larger menu of loan options for your borrowers, right? Let's bring it into real estate. If you work for a builder, you're only showing, if you work for DR Horton, you're only showing DR Horton's properties. You're only showing Lennar or Pulte's properties. Versus as a real estate agent, you may bring your buyers to their developments or their projects, but you may also take them to other projects, or you may take them to resales. So Jessica, so that's the metaphor for on the real estate side, how you would look at a realtor that works directly for a developer versus an independent real estate agent. Okay. So Now everyone's thinking like, my contact is A, right? And the last thing I'll say with that is not to say that one is better than the other, but you should know the difference, right? How is a mortgage broker paid? They're paid on a commission. They're paid from either the borrower or the lender, or they can be paid by both at closing. So they are also paid on the commission. They're also not paid if they don't close, just like you guys. So just a recap for you. The loan officer, they work directly for a lender. Mortgage broker works independently. A loan officer can only offer loans from their employer. So this is why sometimes if you work with a loan officer, they're like, sorry, we can't help them. And you send that borrower to someone else and they're like, sure, here's an option. That's what you're running into, right? Similarly, same thing, the brokerage is going to bring your borrower to different lenders. One thing we say about Motto is we are your personal mortgage shoppers, right? So you tell us what you need, we will go find that mortgage that you specifically need. And then the direct lender, again, just that one menu that your borrower can choose from. Sometimes the direct lenders, there's a talk about cost savings. Again, a mortgage broker can oftentimes shop for loan programs versus sometimes a direct lender may be able to give a better rate because everything is in-house, right? So that's some background information for you guys on the different players in the loan process. Loan types. So we know that there are really like some major categories of loans, right? The type of mortgage that mortgage loan that a borrower obtains is going to determine their interest rate, the loan terms, the qualification requirements, and ultimately type of home they can afford based upon the type of loan that your borrower is being approved for. Now, some of your major categories, your major categories of loans, they're going to be FHA loans, or they're going to be conventional loans. And we're going to talk about those two main categories. A subset on the FHA side, an equivalent is the VA loans. I know someone said, well, what about VA? So VA as well is a popular, but it's still not as common as FHA, right? Most of you are going to be working with either FHA buyers or conventional loan buyers in today's market. So a little bit of background about FHA. FHA is an acronym for the Federal Housing Administration. These loans are called FHA loans. They are backed by the Federal Housing Administration and they're offered by FHA approved lenders. The Federal Housing Administration is a U.S. agency that provides mortgage insurance to FHA approved lenders. So these loans are insured against loss, right, by the Federal Housing Administration. The Federal Housing Administration was established in 1934 to help stimulate the U.S. housing market. The underlying idea was that more people would qualify for mortgages to buy homes if the lenders were provided insurance. Makes sense, right? The lenders are comfortable that in the event of a default, they're going to be made whole. Then they're like, sure, I will give, borrower with the 580 credit score mortgage because, the Federal Housing Administration is going to make sure that I am made whole in the event of a default, right? So the FHA, the Federal Housing Administration is one of the world's largest mortgage insurers, protecting FHA approved lenders from losses, right? Some people are still coming in. The FHA, the funds that they utilize to insure these mortgages is generated through mortgage insurance premiums that are collected from the borrowers. And we're going to talk about that shortly. Most of you probably know that when you take out an FHA loan, you have to pay mortgage insurance premiums. Well, this is how the FHA collects the kitty that they utilize to make these FHA lenders whole in the event of a default. So you kind of look at it like this way, like, yeah, you're giving me a loan, but I'm paying for it, right? I'm paying for the insurance of you giving me a loan when, this FHA type loan. But at the end of the day, on balance, the borrowers still get a better deal than not being approved, right? Or having to be qualified for a different type of loan. And we'll talk about some of the concessions that borrowers enjoy when they obtain an FHA loan. So why do we hear about FHA loans so much? FHA loans are generally easier to qualify for than conventional loans, and they have lower down payments and credit requirements. Therefore, they are ideal for first-time home buyers, right? Because they have lower down payment requirements and they have an ease on the credit requirements. Again, credit scores can be lower. They are ideal for first-time home buyers, all right? If you guys didn't know, having a mortgage loan that's current, of course, is one of the best ways to build your credit score. So once a first-time home buyer, they get a mortgage loan on their credit report that they're paying, and oh my God, once they pay it off, their credit score is much more improved, right? Notwithstanding the fact that FHA loans are very common for first-time home buyers, FHA loans do not have a maximum income limit or credit score. So your FHA buyer can have they can make 6 figures and have an 800 credit score and still desire to take out an FHA loan, right? So notwithstanding the fact that, again, they are ideal for people who have lower, they have lower reserves, I guess you would call it, and lower credit scores, there are many that purchase homes with FHA loans just because they decided that's the route they want to take. They don't want to put down, more than 3.5% or so, right? With regards to credit scores, an FHA applicant can qualify with a credit score as low as 500. Like, you got to search for those. But 580 is preferred. Like, that's generally your most common floor. And many FHA lenders won't go below it. So 580 is your most common floor. You have some that'll go 500, but your most common floor is 580, right? So when you're talking to, you're doing your buyer consultations, what's your credit score, right? So you already have a feel of where this conversation is going to go with their qualifications, right? An FHA loan requires a 3.5% down payment if the credit score is 580 or higher. However, if the score is from 500 to 579, that down payment must be 10%. Now they're getting into conventional land, which obviously they're not going to qualify with that credit score, right? So that's where you're hearing about the 3.5% down FHA loans with at least a 580 credit score. I want to reiterate that every lender, although most lenders, you can find a lender at 580, every lender has a different requirement for their floor for the credit score for an FHA loan, okay? So don't think because your buyer has a 580 that every lender is going to qualify them for FHA. No, that every lender will still have other they can still have other requirements, right? We talked about mortgage insurance. It is mandatory on every loan, regardless of the down payment amount, right? The borrower is going to make an upfront payment, which they can roll into the loan, and plus they're going to make monthly premium payments on that amount, right? Borrowers who put down 10% or more will pay these premiums for 11 years. For those who make a down payment of less than 10%, they're going to pay it for the life of the loan. Most borrowers are going to take advantage of the 3.5%. And so by default, they're going to pay the premium for what? The life of the loan. It's not, it's not going to kill them. So just don't think like, oh my God, you have to pay mortgage insurance. Again, it's a trade-off for the opportunity to purchase a home with a lower down payment, right? So as I mentioned before, the exact rules on how to qualify for an FHA loan, they differ based on the lender, but generally you want to look at a credit score, they can go as low as 580. You probably want to look more like a 620. They want to be looking at a 620, down payment of 3.5% or more, debt to income ratio of 45% or less. stable income and employment, definitely a 2-year employment history. You guys obviously don't have to calculate this, but again, have a framework, have working knowledge of this so that you can have the conversation with potential buyers. FHA loan limits, they are set. There is a limit to the loan amount for FHA loan, and it's set by regions. Low-cost areas have a lower limit than others, and high-cost areas have a higher limit. You see here on the screen an example. This is South Florida's loan limits for FHA. Single family in Martin County is about 500,000. Miami-Dade County, the limit is about 557. And then in Palm Beach, about 557 as well for single family, 1 family, 2 family. And then you can go all the way up to a 4-plex. You guys know that all the way up to a 4-plex is considered residential, right? And this is where we get into having a conversation with our buyers about becoming investors, even as first-time home buyers, right? Because most generally, if your buyer purchases a 4-unit property, they live in one, 9 times out of 10, the rent that is paid by those other 3 units will cover the entire mortgage and then some. So, of course, if you can find a multi-unit property for your buyers that are interested, that is, for me, my thought process, especially if it makes sense based upon their family makeup and what they need in a home, that is always a great first buy. So let's look at the contract really quickly. So we're here to talk about mortgages, but you got to remember everything ties in together. We have a FHA rider. If you know that your buyer is purchasing, is going to purchase with an FHA loan, don't forget to include your FHA rider. All right. And then we have a whole class about the considerations and what you need to be aware of when you utilize the FHA rider, but don't forget the rider. All right, all ties together. Now, the second main category is your conventional loans. A conventional loan is not backed by a government agency. There's no insurance. There's no insurance in the event of a default with a conventional loan, right? They're originated, meaning that they are funded by private lenders such as banks, credit unions, and other financial institutions. Now, because there is no insurance with conventional loans, here's where you get into the lenders having what? Higher credit score requirements, more down payment requirements, right? Yeah, this is September, Jessica. They get into, having just a more stricter approval process because they have no insurance, all right? Similar to other loans, the interest rates are going to vary depending upon the down payment, the mortgage product, and of course, you guys are very well aware market conditions, right? So what are the interest rates today? What are they tomorrow? What are they going to be? What's it going to be in 4 years, right? So that all makes a difference. So this is a quick comparison on the screen. FHA loans, lower credit scores can qualify. Conventional loans, higher credit score. FHA loan, mandatory mortgage insurance. You're going to have it for the life of the loan. If you put down less than 10% for at least 11 years, if you put down 10% or more. With conventional loans, mortgage insurance is required if the down payment is less than 20%. Once you hit 20% loan to value, then you know that mortgage insurance can drop off. Down payments of at least 3.5% on the FHA loan. Conventional loans, down payments range from 3% to 20%. Now, I will tell you, a lot of lenders that we work with, they have products out now to deal with market conditions. And so even our lenders, we have a 1% down product that in certain areas, the buyers can purchase with 1% down. So traditionally, in I guess you would say a balanced market, I can't even say balance because maybe it's never going away. You would see like 3%, but there's currently a loan product available where a buyer can put down as little as 1%. FHA loans, remember, are backed or insured by the U.S. government. Conventional loans are not. And then FHA loans can be used to finance only primary residence, whereas conventional loans can be used to finance primary, vacation homes, rental properties, so on and so forth. No, not a credit score of 900. There's income limits though. It's a credit score of 900. But
Ray, I got a question.
There's 1% down. All right. Now the conventional loans are broken out into two categories, right? They also have a major category. So whereas they do not have, conventional loans are not insured, conventional loans do have the opportunity to be repurchased on the secondary market, which is kind of just as good for the lenders, right? They do have an out, for lack of a better term. A conforming conventional loan is a mortgage that meets the dollar limits and other underwriting requirements set by the Federal Housing and Finance Agency, and the funding criteria for Freddie Mac and Fannie Mae. You guys have heard of Freddie Mac and Fannie Mae before. This is who they are. They're not a guy and a gal. Fannie Mae and Freddie Mac are considered government-sponsored entities, or GSEs. They're quasi, I would describe them as quasi-government entities. Both companies were created by Congress, and they're authorized to perform important functions of the government to be on behalf of the government to provide liquidity. Oh, that sounds familiar. That sounds like the Federal Housing Administration, what they did with the FHA loan. Well, this is another means of providing liquidity is to resell conforming conventional loans on the secondary market, right? The Federal Housing and Finance Administration oversees Fannie Mae and Freddie Mac. Yes, that is the same. That's the same insurance type. Remember, Freddie and Fannie do not issue mortgages themselves. And then neither do they insure mortgages. They purchase mortgages on the secondary market if the lenders wish to sell those mortgages. Most do, right? Similar to FHA limits, a conforming loan has a limit as well. So in 2022, the limit was $647,200. That was the max loan amount for a conforming loan that could be resold on the secondary market. It is now $726,200 for most parts of US, but it's higher in some and more expensive areas. That was an increase of $79,000. That's big. Remember, this goes to liquidity. This goes to lenders' willingness to make loans, right? So now they can now resell loans that are up to $726,000. Now, your ability to qualify for a loan up to $726,200 is a little ease, right? It's lightened because they can resell that. That lender does not have to hold on to that loan and pray that you continue to make payments until it's paid off, right? So remember, any loan that a lender has to hold on to themselves and ensure that you're going to pay it off, they're going to make sure they're going to have a stricter underwriting requirement, right? So now we're moving up into the tighter underwriting requirements. Went from FHA, VA, conforming, now non-conforming.
Ray, I have a question. I'm sorry.
Conforming loan amount are classified as non-conforming or jumbo mortgages. All right, you guys have heard of jumbo mortgages, especially those of you who are in the luxury market. The jumbo mortgages are those that are above $726,200. Because Fannie and Freddie only buy conforming loans to repackage and sell for the secondary market, the demand for non-conforming loans is much less. All right.
Oh,
yep.
Right. There's a guy that keeps trying to ask a question.
Okay. You guys can raise your hand if you have a question. Thanks for that. I have two screens, so I don't see everyone's faces, but definitely raise your hand if you have a question. Thanks, Karen. You guys came in at the same time. Terms and conditions of a non-conforming mortgage can vary from lender to lender, right? Again, remember the interest rate and the minimum down payment are going to be higher because these loans carry a greater risk for the lender, right? Not only is it a higher loan amount, the loans are not guaranteed by any government-sponsored agency or the government themselves, right? So, my luxury agents, just keep that in mind when you're working with buyers who may need to finance a portion. I can tell you most of our luxury or higher end buyers, they'll put a good amount down in cash because they realize most of them want to avoid having to qualify for a jumbo mortgage, right? So what are some other loan products, lesser known loan products? Your USDA. This is your United States Department of Agriculture loan. This is a government loan. It is intended for the purchase of residential homes that are in rural areas. Now, the reason why that's bold is because you would think that rural means like very, 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 very country. And that's not the case. You could be just literally like 11 minutes out from a more densely populated area. And we have a map where we know what areas qualify for USDA. You can be just 11 minutes out from a densely populated area. Port St. Lucie has some of these areas, and you can qualify for a USDA loan. These are wonderful loans. They require very low down payments. Credit requirements are lessened. Income requirements are lessened because the government obviously is trying to populate these areas. I mentioned earlier the VA loan. They are akin to the FHA loans. The VA loans, the Veterans Administration loan, is the government loan. It is administered by the Department of Veterans Affairs, designed for active military members, veterans, and their spouses. This is a very good niche to service. The VA community and those that would qualify for a VA loan is a very good niche to service, specifically because the eligibility requirements are very eased for this community. 580 median credit score, their certificate of eligibility, debt to income ratio must be equal to or less than 60%. For FHA, we said what, 45%. These are at 60%. They do pay a one-time funding fee, but they also have no down payment requirements. That's huge. No down payment requirements. They get competitive interest rates and no private mortgage insurance. What did we talk about earlier with regards to both FHA loan, conventional loans, and really many other loan types? Depending upon the amount of your down payment, if it's less than 20%, then you're paying mortgage insurance. Even with making no down payment, a VA buyer is not going to have mortgage insurance. This is a beautiful loan product. It is a beautiful loan product. Now, I know many people say, well, why do people not want to accept offers from VA and FHA borrowers? Really, it's specifically because of the appraisal and the inspection requirements. We know that the VA, and here we go, going back to your contract, your VA and FHA writer has a slightly heightened inspection standard and also appraisal. And they don't want to have a bad appraisal on the file, on the file for the property. Notwithstanding that, if you know your property's decent and it should appraise, this is going to be one of the most easiest loans for your borrowers to qualify for, FHA and VA, because the requirements are so eased. How many VA loans can an applicant receive? Are they eligible for a VA loan for every property they purchase in their lifetime? Yes, but only one at a time. Very good question. One at a time. All right. So that's your riders. Now, interest rates. You guys just need to, besides, don't try and track the interest rates and everything that's going on right now. We're not going to talk about that. There's a whole other class. But what you should be familiar with is just understanding the types of interest rates, knowing that a fixed interest rate has an interest rate that stays the same for the entire term of the loan, that means that the mortgage interest rate is going to be constant. It's not going to go 4% to start and then jump up to 5%. And you know, we call that variable interest rate. A fixed rate mortgage, that interest rate is going to stay the same. And for that reason, the payments should generally stay around about the same. Now, the reason why I say around about the same is because property taxes can adjust, property insurance costs can adjust. And if your borrower's payments are what we call fully escrow, right? Principal payment, interest payment, taxes, and insurance, that number will change, but it will not, you know, jump up astronomically because the interest rate is fixed. Another question in the chat, can a mortgage broker find new construction loans for an applicant? Absolutely. 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 Remind me when we get to the end, because I might forget, to go a little further into that, just because I don't want to go off course. But when we talk about loan products, there's a lot of loan products that are out right now. And especially for those of you agents that are in the Port St. Lucie area, where you have a lot of smaller private builders, there's a lot of advantageous loan products that are available for you guys. We talked about the interest rate. Once it's locked in, it does not fluctuate with market conditions, all right? Now, an adjustable interest rate mortgage, we know that that is a mortgage where the interest rate will change based on market conditions. Now, I can tell you guys that this might be a loan that someone would consider, right? And possibly you're more sophisticated borrower because they're saying, I want, generally an adjustable interest rate mortgage is going to start with a very low initial interest rate, and then it will adjust at certain points and periods, which they will know. Your buyers will know that. It can adjust every 2 years, 3 years, 1 year, variable. Based on the market condition that we're in right now, with interest rates hovering, you know, 6.5, sometimes touching 7, a sophisticated buyer might say, I want to, the term comes to mind, play the market. And say, well, I want to come in at a lower interest rate because I know that interest rates are going to, I believe that interest rates are going to adjust later. They're going to go lower, and then I will refinance into a lower fixed interest rate mortgage in a year or two, once interest rates come down after this whole inflation dialogue, right? So if your buyers speaking with a loan officer, they determine that they want to do an adjustable rate mortgage, this is likely the conversation that they had. Bobby said, what about loans for very small purchase, like buying land to put a mobile? Ooh, buying land to put a mobile home on. Yeah, that is not, you're looking at, that's a good question. You're looking at what we call a non-QM loan. And those are going to be at a higher interest rate. The lenders in that regard, when you think about it, they have no security. They're not interested in land, right? So your pool of, there are loans available. So let me say that, but your pool of available loans is much smaller because you're not going to find very many lenders that want to lend just on land, right? That's not much security for them. All right. So how do we get to the closing table? I know this is what everybody came for. So now that we know about, you know, who the loan officer, mortgage broker, the loan products are, how do we get to the closing table? And you guys have a lot more influence in this space than you might think. Here's why. It's important, and this is, like I said, we're going to talk about marketing. It's important that, I'm not sure how you guys market negotiations. It's important that you encourage your buyer pool to be what I call purchase ready. What is purchase ready? Purchase ready means having a loan pre-approval. Now, how do we get a loan pre-approval? We're going to talk about that just shortly, the application requirements. But when you communicate, especially after you guys have this class today, right? When you communicate to your buyer pool about how quick the process is to find out whether or not you you are qualified for a mortgage and the types of mortgage products that are out there, you want to build up your funnel, right? Even if someone say, oh, I want to continue to rent for the next year or so, or, you know, I think I want to move, but not just, okay, great. But let's at least get you purchase ready. Let's get you a pre-approval, because you never know when the opportunity might present itself. And it's best for you to be aware of where you lie than to wait, right? We're going to talk about a little bit more once we get past this section about marketing money. I tell the Experts University community all the time, there are a lot of buyers that they have told themselves that they can't qualify. They don't know about all the loan programs. You guys should know about the loan programs, right? So that you can motivate them and inform them, and they'll take the next step, right? So how do we get to the closing table? The first step is, of course, the pre-approval and application process. For you guys' information, the acronym that we use in lending and qualifying a borrower for a loan is IPAC. IPAC, IPAC. We look at income, we look at the property, we look at the borrower's assets, and we look at their credit. Very simple. I know all the communications back and forth makes it sound like it's way more complicated than that, but that's all we're doing. We're looking at their income. We're going to look at the property once you guys go get it under contract. But during the pre-approval process, we're looking at the income. We're looking at their assets, which we determine that's what they're going to use for their down payment, as well as we want to see some money's left over so that you're not just completely wiped out after you close. And then, of course, we're looking at credit. It is literally that simple, right? So that's what we're looking at with the pre-approval process. Once your buyer goes under contract, then the contract and the borrower's file is submitted to the underwriter for underwriting. But if you have a strong pre-approval, the buyer themselves have already gone through a very in-depth review. So now all we're looking at is matching the property. So we've underwritten the person. Now we're matching the property. They'll get their conditional approval. After they get their conditional approval, then it's clear to close. That's literally everything that's going on in the background, right? It's a lot of paper passing, but that's what's going on when your borrower goes under contract. So let's look at this a little bit more closer. The loan pre-approval process. Now, you guys know, and I think this should be a foregone understanding and agreement that you guys are not working with anyone who does not already have a pre-approval, right? If they do come to you, you're having an initial consultation, maybe 15 minutes to tee them up, get them in your database, and then immediately get them in front of a loan officer, a lender, your mortgage broker to get a pre-approval, right? I would say any buyer that's not prepared for that discussion is probably not a serious buyer, right? That's the other conversation I want to have you guys. Make sure we all get 24 hours in a day. You don't want any tire kickers. You want to make sure that you are working with a purchase ready buyer, right? A purchase ready buyer is one that is going to engage with the pre-approval process. All right. Don't do anything, guys. Don't start showing, please. Don't even go on your MLS. Like, you can have a brief conversation with them to find out what their likes are, so you can get them on a drip campaign. This is what I would suggest. You get them on a drip campaign, dangle the carrot in front of them. But when you start getting into, don't go too far without a decent pre-approval. And please don't get the pre-approval that, the loan officer or lender sent to them in 5 minutes. That is not true. That didn't happen. That was not a pre-approval. That was a template that was just sent over, and you're going to possibly be sorely disappointed when it's time to get to closing and your buyer is not approved, because they were never fully pre-approved. They were never fully examined at the pre-approval process, right? So 6 documents, very easy. I always call it the tools. 2 most recent pay stubs we're asking for, 2 most recent federal tax returns, 2 more recent bank statements, 2 years most recent work history, driver's license, and social security number. Now, of course, he said pre-approvals rock. Now, of course, one thing with pre-approvals, I want to reiterate this. When you obtain a pre-approval from your buyers, you want to reach back out to that lender loan officer and say, did you get their financial information? Did you actually receive the pay stubs? Did you actually receive the tax returns? Hello, did you actually receive the bank statements? And send those to the lender for pre-approval. Because you guys know there's a difference between pre-qualification and pre-approval. You can be qualified just because you work, right? And all those different things, but are you pre-approved? Yes, Ms. Trapp, go ahead.
Hi, Ricole. First of all, this is an awesome, awesome class, no matter how experienced we are, which I'm not. But you're bringing up a very good topic right now, the pre-approval versus the pre-qualified. I'm working with a credit union, as a matter of fact, and they just told me, I reached out to the lender, and he just told me that they don't issue pre-approval letters. So then I went on to asking, okay, are we able to obtain, with the buyer's request, of course, a DU? So he said, yes, they can provide that, but they will not issue a pre-approval letter. And I did ask what you just said, have you received the documents from my clients? And they said, yes, credit was run, yada, yada, yahtzee. What do I do in a situation like that? Because I can't deter the buyer from who she already went through, but I don't know if anybody else is having that issue out there.
Now, one thing I would tell you is, exactly, it's interesting that they'll give you a DU, but they won't give a pre-approval, because a DU is going further than a pre-approval. So it may even be just a semantics thing. Maybe their policy is not to give a pre-approval because they just don't want to use that term. But if they've gone so far as to provide a DU, which, like Jessica said, the DU is where the underwriter has really gotten involved and really dug into the documentation.
Exactly.
That's even better. But again, I would ask them the same questions. With your DU, they've confirmed that they've received financial documents, then you might be in a good place. I'm gonna say might. You might be in a good place, because that's the other thing, again, terminology and process can be different. So one lender, they're saying they're not giving you a pre-approval, but they're going as far as a DU. For other lenders to go to a DU, like we're 75% down the road and we're just waiting for a property. We're just waiting for a contract.
Yes. Well, I'll try again, but I did that. I said, if you're willing to give a DU, what's stopping you from issuing
Give
the
a pre-approval letter?
Yeah, but thank you.
No, that's a very good question. Ashley said she had the same scenario. With the credit union, they usually only supply the first page of the DU and not the a pre-approval letter. So again, I would say to you that even if they don't if they don't give you a pre-approval letter, the DU has gone way further. Like I said, you're 75% of the way there. And if they'll give you a if they'll give you a DU, then you should be able to rely on that. Yeah,
absolutely. Thank you.
Ken said, will the lender send to underwriting before you have a property? Yeah, so that's where we're having a conversation about the DU. That's where the underwriter is going further into the financial information that has been provided, and literally all they're waiting for is you to match it with the property. This is where, for example, how we're able to get a clear to close in 10 days, 2 days, 3 days, because we've already done everything we need to do with regards to examining the borrower, the person. Now we're just waiting for the property. And you guys know that most times what's holding you up with the property, especially if it's single family, not a condo, not needing to get all types of docs, is an appraisal, right? So we're able to get an appraisal quickly and get that through. Or some lenders even have appraisal waivers. They're able to do, you know, a drive-by or just look at the property records. And so we're really getting lightning fast approvals, right? So yeah, I hope that answered your question. And again, like I said, just for clarity's sake, it may be a matter of just process for that credit union and semantics, because a pre-approval is a step back from a DU. A DU is way down the road and they've done a lot of work already. So you could be in a good place. Underwriting. What is underwriting? Why do we call it underwriting? Underwriting is a process through which an individual or institution takes on a financial risk for a fee. So I'm taking the risk of loaning you my money, but I'm going to charge you for that, right? In our case, obviously, our lenders are taking the risk of providing a loan for a fee. Just a little bit of background knowledge, just a little, did you know? The term underwriter originated from the practice of having each risk taker write their name under the amount that they were willing to loan, right? So underwriter. So I wrote my name under this person and this amount in an agreement to lend this money for a fee. So that's just a little, did you know, some history on the word, right? Etymology. Credit report review. The lender will generally use the middle score of the borrower, right? And the lower middle score of all borrowers. So if you have a husband and wife, and the husband is 720, 730, 740, the wife is 750, 760, 780, they're going to use 760. No, sorry, 730, the lower. I said 720, 730, 740. Going to use the lower of the two, the lower middle of the two, right? So the lower middle score of all borrowers. All right. Your lender may do this, and I should have included the number for you guys. I have it on my wall. One thing you might want to tell your borrowers, some like, did you know, just so you guys can show that you're in the know, is they want to opt out when they're getting ready to go for a pre-approval. They want to opt out of pre-screen, because just as soon as your lender runs a credit check, their information is provided to every hound on God's green earth, and their phone is going to blow up with calls of people trying to offer them a loan. And it can get very frustrating. It can get very confusing, right? Because some of the scripts that the callers have will confuse your borrowers into thinking that, oh, this is my credit union, and it's not, right? So you want to do, I think the site is actually opt-out pre-screen. Is the site specifically that you would use, that the borrowers would use to opt out of that pre-screening, and they need to do it. No problem, Carmen. See you next time. They would need to do that at 5 days before the lender runs their credit. Literally, guys, I've seen a call log before. It was ridiculous. The call log was just ridiculous. The numbers they just kept calling. All right. All right. So let's look at your contract. This is important. The pre-approval process, not the pre-approval, but the loan approval itself. In the contract class, I remind you guys that this is a date that you cannot miss. You want to remind your lender. You obviously you will have this date logged yourself as the realtor. And if you have a transaction coordinator, your transaction coordinator will be watching it as well. But the loan approval deadline, make sure that your lender is on the same page, or your loan officer is on the same page about making sure that you have a loan approval by that deadline. Your loan approval deadline is found in paragraph 8 of the contract, right? When you executed the contract, you agreed to a deadline by which the borrower would have will provide the seller with notice of their loan approval, right? Oops. By that deadline, there's 3 things that should happen with regards to the loan financing. If you do not receive an approval by that deadline, you want to either get an extension to the loan approval deadline and probably even the closing date, because if the lender can't get an approval by then, they're likely not going to be ready to close either. Do we need to cancel the contract? What's the holdup on the approval? Is it likely that they won't be approved and so you should just cancel? Or the lender says, we think, it's just this, but we just don't have the approval just yet. And so you continue. Now you can have a situation where the seller does not agree to extend your loan approval deadline. We know that the loan approval deadline is a contingency, right? That gives the buyer the ability to cancel the contract if they do not obtain loan approval. So maybe the seller is saying, no, I don't want to extend the loan approval deadline, but the buyer also does not want to cancel, and they feel confident that they're going to be able to get the loan approval. So you proceed. Now for you, if that is the case in your situation, I would suggest that you get written confirmation from the buyer that they are aware that they have not received the loan approval, yet they have decided to proceed with the transaction at the risk of losing their escrow deposit. This is the part of the contract, guys, where we talk about losing escrow deposits. Okay? So make sure that your lending team is on the same page about this deadline. Now, outside of that, just because we're discussing, you guys should know, Evelyn, if you were trying to say something, raise your hand. I'm sorry, I didn't know. Okay.
Yes,
I didn't know.
sorry, but I was completely lost in my screen. How we handle that, because that's a private conversation with the buyer. So what kind of document do we have to address?
What's private? Let me make sure I understand.
I mean, if if they don't receive the loan approval, I know the seller side, we have to notify them. I'm okay with that. But if the buyer want to proceed with the purchase, even if they are not approved, how we handle writing?
How were you? Say that again.
Because just in case they lose their escrow deposit.
Absolutely. So that's an easy conversation. That's saying, Mr. and Mrs. Buyer, our deadline for you to obtain a loan approval is today, August 3rd. And today is also our deadline if we do not obtain an extension from the seller to either cancel the contract or we proceed. But if we proceed and you don't obtain approval from the lender, then your escrow deposit is at risk.
Yeah, that my idea is getting down writing, just a notice, and I don't know how to handle it because it's not an addendum. It's not part of the contract. It's gotta be email.
Yeah, correct. You could just send an email. Send an email to them, say confirming our conversation, right? That you intend to proceed with the transaction, notwithstanding the fact that you don't have loan approval, with the loan approval deadline being today, August 3rd.
Okay, I got it. Okay, I know how to do it now.
Now, the other way that you would be documenting this is the contract calls for the buyer to give the seller written notice of their loan approval status, regardless of what happens. If they get approval, they're supposed to notify the seller in writing. If they don't have approval, they're supposed to notify the seller in writing with either a cancellation or notice that they're going to proceed. So you'll have their writing anyway. Confirm. That's if you're following the contract. The contract clearly says that you're supposed to give the seller notice in writing of your loan approval status by that loan approval deadline.
Yeah, I've been in a situation before when they wasn't approved and I get the confirmation from the buyer. So they never get the loan approved. I know that part, but I was interested how to handle the other side. It wasn't me in my case. So
how to handle the other side?
The other side when when the buyer knows already that it's not gonna be approved, and getting that information on writing. But I'm clear now. I got it. I got it.
Okay, okay.
Thank you so much.
So Bobby has a question. Let's go back to the contract. So Bobby's questions are weekends included in the loan approval day count from the date of execution? Absolutely. On the FAR bar as is, I have to make sure that I put that in there. The FAR bar as is, calendar days are used to compute time periods. And so you count every day when you're getting to your deadline. You don't skip weekends, holidays, you count every day. So you keep telling us. I do, I tell you guys every time. You count every day. TRID. TRID is an acronym used to refer to the TILA-RESPA Integrated Disclosure Rule. TRID is a federal law that regulates the mortgage process. This is what we get into when we get into the disclosure period, right? Where we must give the borrower 3 days opportunity to, we call it cooling off period prior to closing, right? Now, how do we tie this back into the contract? Because I got an urgent email from a realtor and she said, oh my God, Ricole, what do I do? I got the clear to close, but the lender is telling me that I cannot close for 3 days. We were supposed to close today. But the lender is telling me that they can't close for 3 days because the buyer has to get their 3-day cooling off period. In your contract is a built-in extension of the closing date to address TRID. Paragraph 5A says, in the event closing funds from the buyer's lenders are not available on the closing day due to Consumer Financial Protection Bureau closing disclosure delivery requirements, if it's a finance transaction, and loan approval has been obtained, this is the language that has been added to this section because this section was used and abused for many years until this language is added. Loan approval has been obtained, lender's underwriting is complete, and the closing date will be extended for not more than 7 days. It used to be 10 days, right? If loan approval is obtained and the lender's underwriting is complete, then the closing period can be extended. Now, the reason this has been added is because they want to be clear that you can't use this extension to continue to get your clear to close. No, you have to have your approval. Underwriting is complete. All we're waiting for is to give that borrower their cooling off period. Bobby's question in the chat, is there any way to waive TRID? There is an extreme way that a buyer can waive TRID. There is a very, we call it narrowly tailored circumstance where TRID can be waived, but they have to, there's a lot of disclosure documentations. It's a very narrowly tailored circumstances where TRID can be waived, right? Like if they're in dire straits, they're gonna lose their house, those types of things. Like it's clearly documented. All right. So your relationship with the loan officer. I cannot impress upon you guys in this market how important it is for not only for you guys to understand the lending process, but have a strong relationship with your loan officers, to the extent that you ensure that your loan officer respects your timelines, right? Your loan approval deadlines, your closing deadlines, because not every seller or listing agent is going to be agreeable to extensions, right? And we know that I've gotten this question before, so I'm gonna just go ahead and lay it out there. If a lender blows a closing date, and let's say, for example, your buyer loses their escrow deposit, they always say, can I go after the lender? Not really. I mean, you could, but there's no contract there. The lender, what are you going to sue them under? You're going to sue them under, negligence or something? That's really your cause of action, because outside of that, you would have to sue them based on a contract default, meaning you were in contract with the lender for the lender to agree to lend you money and close your contract by this particular date. But outside of that, they just didn't perform a service, right? And so because there's very little recourse against the lender, all hands must be on deck to make sure that these timelines are respected. The last thing I want to say to you guys is a lot of lenders, what about the lenders? First of all, they don't even look at a Florida contract, even if they are in Florida. I have lenders that are on loans that we close that are not even in Florida. And so they're not familiar with the closing process in Florida. And so they're asking for information and drawing out timelines that they should not, right? So this is where you guys have to get engaged with these lenders from the time, good job, Ms. Trapp, from the time you guys are notified, okay, well, your buyer has brought you a lender. Hey, listen, my name is, I'm, their realtor. Here is how we work. Here is how we do business. We want to ensure that we have a pre-approval we want a pre-approval. We want a clean pre-approval. We want to ensure that you've looked at their financial documents. I want to ensure that when we go into contract, you're going to look at the insurance. You're going to make sure the taxes are in line, and we're not going to run into underwriting issues because the ratios are off, right? Right? I want to make sure you're going to tell me, can this buyer really afford this property? How soon can you close? Some lenders, they can close. Like I said, we have deals we close in 10 days, or at least had to clear to close in 10 days, right? How soon can you close? Will this property even be approved by the lender? We're in South Florida. We have condos. Is this going to be approved? Are there any limitations to consider based upon the intended loan type? So if you know you're going out for seller concessions, we know that there are some loans have maximum seller concessions. So you would need to know that. And then can the buyer pay more than appraised value? We still want to know. That's more of a COVID era, but we still want to know, right? Can they pay more than the appraised value? Now, all of this is going to become by virtue of being in very good communication. Gone are the days where you get your buyer under contract, you throw the contract into title and with the lender, and you on to the next deal until it's time for closing, because what if something happens? Now, one thing I always tell you guys, if you have a transaction coordinator, you don't need to make these follow-ups, but your transaction coordinator can be following up with the lender each week, and definitely multiple times per week, as you probably at the beginning, at the end, to make sure that everything that the lender needs, that they have, right? Because sometimes these lenders, they get busy and they will need a document from your borrower, and the day gets away from them, and they've never asked for it, right? And your transaction coordinator could have followed up for that information, right? So stay in constant communication, receiving regular updates from the lender is something that you want. Now, staying current with mortgage market and trends. So the interest rate changes. I want to tell you guys again, a lot of realtors have sat back and said, oh, the interest rates are too high. Like, you drank the Kool-Aid. You drank the Kool-Aid from MSNBC, CNN saying interest rates are too high. But guys, we're still closing. And lenders don't make money unless they do what? Lend. And so they're going to come up with loan products to keep the money flowing, to keep borrowers borrowing. Now, I think that one of the tools that came out in the past 6 months or so that I still don't see many realtors utilizing is the seller concessions for interest rate buy down. All right. What is that? Using the seller concession to buy the interest rate down. There are different variations of this program. 3-2-1, 2-1, 1-1 buy down. And what that's saying is that, for example, in the case of a 3-2-1 buy down, the interest rate using the seller concessions, those monies are simply placed into the buyer's escrow account. so that the buyer is going to be qualified at whatever the market interest rate is. They're going to be qualified at 6.5%. However, if you guys negotiate a seller concession that allows that borrower to qualify for a 3-2-1 buy down, in year one, their payment is going to be based upon, or it'll be effective of 3.5%, because it's a 3% buy down in year one. In year two, it's a 2% buy down. So now they're at 4.5%. Year three is a 5.5% interest rate payment. Understand that on the back end, that full 6.5% mortgage payment is still being made, but the lender is using those seller concession funds that are placed in the escrow account to make that full payment. That's how that shakes out. So your borrower is paying less, but the full mortgage payment is still being made, right? So what are we accomplishing here? Number one, we want buyers to enjoy the opportunity to purchase the home they want to purchase, right? They may not be crazy about this particular interest rate, but oh, by the way, we can get you to where you're really only paying what is the effective rate of 3.5%, 4.5%, and 5.5%. And we anticipate that by year two, you should be refinanced into a lower fixed interest rate. Oh, and by the way, you're still gaining equity. You're still writing off taxes, right? You're still saving money if you were renting before. And so these are the conversations, the benefits of negotiating and using a seller concession for interest rate buy down in this market. These are the type of conversations you should be having with buyers that are telling you, oh no, this is not my market, I should just wait, right? There are down payment assistance programs. What is the most popular down payment assistance program right now? Hometown Heroes. I mentioned to the group on Monday in our sales huddle, that money is going fast. That particular program, that money is going fast. We started off at 100 million. As of Monday, we were at 50 million. I anticipate by this coming Monday, we'll be at 40 million, because every time we check the balance each Monday, we're going down about $10 million. So that means if you guys have any buyers that know about the Hometown Heroes program that they wanted to take advantage of, or you wanted to get that in front of them, you probably got about 4 weeks before the money's run out, because it is literally going out at $10 million per week at this rate as we watch the balance that's reported. What are some other loan programs? This is how you guys are gonna feed your pipeline. You guys are saying it's quiet, nobody wants to buy. Well, they don't want to buy because they don't know about 1% down. They don't know about Hometown Heroes. They don't know about 3.5% down. They don't know about a 620 credit score, right? I tell my realtors, you need to market money, because that's what's going to get them off the fence. So all the loan programs that you guys are learning about, market the loan programs. I mentioned to the group on Monday, I see many realtors are not aware of investor loans. Your buyers, your COVID buyers, because they locked in at 2.9%, or 1.9% or 3%, they're probably gonna say, I don't want to sell. I have a great interest rate. I love my house. But how about it's time for them to become investors? There are investor loans that will qualify your owners based upon the revenue that the property is going to generate, right? Not their income, but the income that the property is going to generate. So all of a sudden, not only do they have a great interest rate in their primary residence, they now have an investment property that's generating passive income for them. How much of a hero do you look like when you've gone to your COVID buyers and said, congratulations, you guys did it. You got in before the interest rates went crazy. Here's something that you can take advantage of now. Even though the interest rates are 6.5%, it doesn't matter. It doesn't matter because you're not paying that mortgage. Your tenants are paying the mortgage, right? Now you guys look like the strong real estate advisors that the world expects you to be, right? Ken says, how do you find out about current loan programs from the lender? Absolutely. This is where you guys, whatever, whoever you work with, again, us with Model Mortgage, we send out loan programs to our realtor partners as soon as they come out. As soon as they come out, between our sales calls and emails and our one-on-one calls, we're getting loan programs out to them, because this is how you're going to keep your buyers, your funnel, your buyer pool open. They need to know there's money out there for that, right? So take what you guys have learned and inform your consumers. Now, I can tell you today from where I sit, and this is a motto of motto. We have a loan for every home. I assure you, we have a loan for every home. Now, some of your buyers, they may, have a slight situation. It may take a little, maybe somebody has down payment challenge, or they have a credit challenge, or, employment. They haven't been working 2 years, something along those lines. But notwithstanding that, there's a loan, guys, believe it or not, there is a loan for every home, all right? And I wouldn't be offended if you guys take that and put it in your marketing materials, that you have relationships where you can find a loan for every home. Do I work with out-of-state clients? I don't personally work with out-of-state clients, but I have relationships with lenders in all 52 states. Model Mortgage is a national brokerage, national mortgage platform. So if you have out-of-state clients that you need a referral for, feel free to let me know. All right. Lastly, post, promote, and share your knowledge. Right now, everyone's just watching. They're just looking. They're just consuming information. They're consuming information. Everything that you've learned, all the different loan products, how your buyers can buy now, how your owners can become investors in this market. Post, promote, and share that. The last point I'm going to make is I told this to the group on Monday in the sales huddle. You guys realize we're talking about this inventory issue. One feature, yeah, I see you starting to post now more. You've been doing that for some weeks now. One feature of our real estate market right now that is affecting inventory is Airbnb. It is reported, and it's true, because we have Airbnbs. We personally, me and my husband, we personally have Airbnb. An Airbnb property rented out just 4 weekends, just 9 days, will cover the mortgage for the entire month. So why do they have to sell? They don't have to sell. They can put the property on Airbnb, rent it out for just 9 days, and they've covered their mortgage. So that's why you also see a lot of property, whereas others would have sold their properties, like, oh, I don't want to be a renter, I don't want to be a landlord, I don't want to rent this property out, or I don't want to have to be responsible. They can still own that home, have access to that home, rent it out for 9 days, and still cover the mortgage with profit. Market the money is my takeaway. Exactly. New perspective on marketing. Wonderful. Thank you so much, Bobby. That is exactly what I wanted to hear. Market the money. Get your people off the fence. Let them know there is a loan for every home. Get a link. Tell them to contact you, to get on your calendar for a consultation, to get with you for your, we would love to work with you guys as your loan partners. To get you guys pre-approved, get you some pre-approvals, so that, again, we're still closing. We're still closing. Yes, that was a question. New construction loans. So that question actually came up the other day. So what I wanted to tell you guys about that is, when you take your buyers out to, say, for example, your DR Hortons, your Pulte's, your big builders, they oftentimes have mortgage, they have funding that's attached to their companies, right? They're pretty much a one-stop shop. So they have real estate, they have lending, and they have title all in one place. Oftentimes they're going to offer some crazy concessions to your buyers to continue with them as their lender. which sometimes makes sense. Your buyer has to know their numbers, because you can get crazy concessions here, but you pay too much for the house. I'm just saying that's how it happens. But outside of that, what I was going to tell you guys that are in Port St. Lucie, and you're working with buyers, or you're working with small developers, or you're working with buyers who own land, or they have purchased land, we have a loan product called a one-time close. One-time close will allow your developers, your builders, to receive the proceeds for the construction project at the front, at the beginning of the transaction. This is huge for your smaller developers, because most developers, they do what? They pay the cost of the construction at the beginning, and they don't get paid until the property is delivered. One-time close with our lenders allows for your buyers to begin construction with private, smaller builders. The builder is paid. They're paid in draws from the beginning of the construction, so that by the time the product is delivered, the builder has not fronted an entire construction cost. That is humongous. So that also helps with the inventory issue. So for those of you that are in Port St. Lucie, and you have buyers that are looking at, they may have land, or they're looking to reach out to us, reach out to me, Julie. Contact information is, oh my gosh, all this time you guys have been coming in. Most of you should have gotten this. I forgot. You guys should have told me the handout. The handout. My contact information is in the handout, as well as here on the screen. Just shoot me an email. I'll jump on a Zoom with you and go over the different loan products, but that is huge. Those of you that are up there in Port St. Lucie, make sure that you get with those small builders, and they'll love you too. If you bring that opportunity to them, they will love you. All right, guys. That's all I got for today. Are there any other questions? Got to drink some water. Been talking for an hour and a half. Just shoot me a message. Shoot me an email. Let me put my model email address in the Jackson.
Raycole, I just wanted to say, since the last class I took,
You've been MIA. Where you been? Where you been, sir?
Well, I don't know why. I don't think I was getting the text for a little while, but I started getting them again. But you had that workout 2 times a day for 45 minutes.
75 days. I'm on day 26.
So
this is 1/3 of the 1 gallon of water per day I have to drink.
yeah, but yeah, you've definitely been motivational lately.
I'm trying. I was telling, I'm gonna need therapy after this 75 hours. It's making me think about my life. It makes you become very intentional. I see your question, guys. Give me